The S&P 500 is one of the most recognized stock market indices in the world. It's a barometer for the US economy and a go-to investment vehicle for millions. But how well do you really know the S&P 500? You might think it's just a list of 500 companies, right? Wrong. There's so much more beneath the surface. Some facts are downright shocking. Its importance extends far beyond simple stock tracking. It represents the heartbeat of the US economy and serves as a benchmark for countless investments worldwide. So buckle up, because today we're diving into the hidden truths about the S&P 500 that most people, including seasoned investors, don't know. Prepare to be amazed by the complexities and intricacies behind this financial powerhouse. Section 1. Not actually 500 companies. Let's start with a twist. Despite its name, the S&P 500 doesn't always have exactly 500 companies. Shocking, right? This can happen because of mergers, acquisitions, or delays in replacing companies that leave the index. For example, when two companies in the index merge, their combined entity takes up one spot, temporarily reducing the count. So, while it's branded as 500, the actual number can fluctuate. This discrepancy can catch even savvy investors off guard, as they assume the index is more stable than it truly is. The fluidity in its composition reflects the ever-changing nature of the stock market, reminding us that even stalwart indices are not immune to corporate evolution and economic dynamics. Section 2. Dominance of the top 10. Here's another jaw-dropper. The S&P 500 isn't as evenly distributed as you might think. The top 10 companies in the index often make up more than 25% of its total market capitalization. That means a quarter of the index performance hinges on just a handful of companies, usually tech giants like Apple, Microsoft, Amazon, and Alphabet. If these companies stumble, it has a massive ripple effect on the entire index. This concentration of power underscores how much influence a few corporations wield over the broader market. It also highlights the risks and rewards of investing in an index so heavily weighted toward a small group of dominant players. Understanding this concentration is key to grasping the S&P 500's true structure and the volatility that can arise when these titans face challenges. Section 3. It's not just American companies, despite being the Standard & Poor's 500 and widely regarded as a US index. Many of the companies within it generate a significant portion of their revenue overseas. In fact, about 40% of the revenue from S&P 500 companies comes from international markets. This global exposure means that the index is influenced by more than just the US economy. It's tied to global trends and events. Trade wars, currency fluctuations, and international regulations can all ripple through the index. This interconnectedness makes the S&P 500 a global investment vehicle rather than just a reflection of the US market. Investors must consider how international dynamics play a role in the index performance, revealing its true complexity and reach. Section 4. Not all sectors are equal. The S&P 500 covers 11 sectors, but they're far from equally represented. Technology has consistently been the dominant sector, making up around 25% of the index in recent years. Meanwhile, sectors like energy and materials often account for less than 3% each. This imbalance means that the S&P 500's performance is heavily influenced by a few key sectors. When tech thrives, the index often soars, but when it falters, the entire market can feel the impact. This uneven distribution of sectors illustrates how some industries drive the economy, while others play a smaller, yet still important role. It's a reminder for investors to understand the sectoral composition of their portfolios and the broader market. Section 5. The rigorous selection process. Think getting into the S&P 500 is just about being big. Think again. Companies must meet strict criteria to be included. They need a market capitalization of at least $14.6 billion, positive earnings in the most recent quarter, and profitability over the last 4 quarters. Plus, they must have adequate liquidity and a minimum public float of 10%. Even giants like Tesla had to wait until they met all these benchmarks. The process ensures that only stable and financially sound companies are included, maintaining the integrity of the index. This rigorous selection underscores the prestige of being part of the S&P 500 and the challenge for companies striving to make the cut. Section 6. The committee has the final say. Here's a fact that surprises many. Inclusion in the S&P 500 isn't purely formulaic. A committee of analysts and economists makes the final call. This group evaluates qualitative factors, like the company's overall financial health and representation of the U.S. economy. This human element means that decisions aren't always predictable. For instance, a company might meet all the quantitative criteria, but still be excluded due to strategic or qualitative considerations. This discretionary power adds an element of subjectivity to the index, which can influence market movements and investor expectations. Section 7. The growth of $1. If you had invested $1 in the S&P 500 back in 1926 and reinvested all dividends, it would have grown to over $10,000 by 2023. That's the power of compound interest and consistent market growth. However, this growth wasn't smooth. The index has endured wars, recessions, and market crashes along the way. This historical performance showcases the resilience of the market and the importance of a long-term perspective. It's a testament to the enduring value of the S&P 500 as a wealth-building tool, despite the inevitable ups and downs of the market. Section 8. The missing companies. Over 1,000 companies have come and gone from the S&P 500 since its inception. Some were removed because they underperformed, others were acquired, and some simply went bankrupt. Big names like Kodak and General Electric, once pillars of American business, are no longer in the index. It's a stark reminder that even giants can fall. This turnover highlights the dynamic nature of the index and the constant evolution of the market. It also serves as a cautionary tale for investors to never become complacent, as even the most established companies are not immune to change. Section 9. Dividend Dynamos. Contrary to popular belief, the S&P 500 isn't just about growth stocks. Many of its companies are dividend-paying powerhouses. In fact, about 80% of the index companies pay dividends, making it an excellent choice for income-focused investors. These dividends have historically contributed about 40% of the total returns from the S&P 500. This blend of growth and income demonstrates the versatility of the index, appealing to a wide range of investors. Understanding the role of dividends in long-term returns can help investors make more informed decisions about their strategies. Section 10. The impact of stock splits. Stock splits don't directly affect the S&P 500's value. They do impact its composition. When a major company like Apple or Tesla splits its stock, it can influence the index weighting and investor perception. This can lead to short-term volatility, even though the fundamental value remains unchanged. The psychological impact of stock splits often drives increased trading activity and attention, reflecting how perception can influence market behavior. Understanding this phenomenon can help investors navigate the nuances of market dynamics more effectively. Section 11. Passive versus active management. The rise of index funds has made the S&P 500 a cornerstone of passive investing. Over $7 trillion is tied to the index through mutual funds and ETFs. Yet, the S&P 500 often outperforms actively managed funds, proving that sometimes simplicity beats complexity. This trend highlights the efficiency of passive strategies and the difficulty active managers face in consistently beating the market. It's a powerful argument for the merits of low-cost, long-term investing. Conclusion: the S&P 500 is much more than a list of 500 companies. It's a dynamic, ever-evolving snapshot of the U.S. economy and a powerful tool for building wealth. From its global revenue streams to the dominance of tech giants, the S&P 500 holds secrets that can shape your investing strategy. Now that you're armed with these shocking facts, how will you use this knowledge to your advantage? Understanding these intricacies can empower you to make more strategic investment decisions and harness the full potential of this iconic index. Remember, knowledge is power, but action is where the magic happens. Thanks for watching, and don't forget to like, subscribe, and share this video to spread the financial wisdom.